Hi, everybody. Thanks for joining me for part two of our lesson on financial markets. We're going to start out this lesson by talking about basic rights of common stockholders. Now, stockholders are people who are part owners in a company through their ownership in stock. And there are two types of stockholders that we're going to talk about, common and preferred. The first one that we'll talk about, common, these are stockholders that have voting rights, which means they can go to the annual meeting of a company and vote on different decisions that the company has to make. So, for example, if the company wanted to get involved in different mergers and acquisitions, they may vote on these things at an annual meeting. They may vote on members of the board of directors. So, common stockholders have the rights to vote on these types of issues. That doesn't mean that every common stockholder shows up at the annual meeting. All right. In many cases, common stockholders will defer their vote to somebody else through what they call a proxy, which basically means that I'm going to let this person vote for me, so this person will vote for themselves and they'll vote on my behalf. And common stockholders will do this for a couple of reasons. One, they don't necessarily feel confident that they know enough to make an informed decision on voting. And two, is there are logistical challenges to being present to vote on these issues. Okay, next, common stockholders have a right to dividends. Dividends, as you may recall, are when a company takes a portion of its earnings and pays out money to shareholders. Okay, now corporations are not required to pay out dividends. Dividends are a decision. The payout of dividends is a decision that leadership makes. So you might be wondering, well, why would a company pay out dividends to common stockholders? And there are a few reasons. One, they're looking to make sure that common stockholders are satisfied with the company and their investment. And two, they're also looking to make sure that their stock is attractive on the marketplace. Okay. Common stockholders also benefit from capital gains. And this is the return on investment that they receive when the value of a stock increases above what they paid for it. So, for example, in around 2010, Home Depot stock was trading somewhere between $22 and $28 per share. 2020, it's trading closer to $200 per share. This means if you bought their stock in 2010, you were a common stockholder then, and you were still a common stockholder in 2020, you would have seen the value of your stock increase by $170 to $180 per share. All right, that difference, that return on investment there, that's your capital gains as a common stockholder. All right, they also hold a preemptive right. Not always. This can vary by state, and we'll get into that in a second. But a preemptive right basically means that if the company is going to issue new stock to generate capital for a project or expansion, that common stockholders have a right to purchase that stock before it's made available to the public. Now, preemptive right is not available in all states. In some states, the preemptive right only exists if a company has it specified in their charter. So this does vary from location to location. And then finally, the right that all common stockholders hope they never have to use is the right to a residual claim on assets. And a residual claim on assets essentially means that if a company is to go bankrupt, that common stockholders will be paid out something when the company liquidates its assets. The revenue generated from the liquidation of assets will be divided amongst common stockholders and paid out after all others who have claims are paid. This means that anyone who has a loan that needs to be paid or a bond that needs to be paid or anything such as that will be paid out before common stockholders. Common stockholders are essentially the last to be paid out, but they do have a right to a residual claim here. Now, preferred stockholders are somewhat similar to stockholders, but there's a few critical differences. First, they don't have any voting rights. Okay. Next, they get their dividends before common stockholders, and their dividends are specified. So when you purchase preferred stock, generally speaking, the dividends are already laid out. The company, again, does not have to pay out dividends, but if they do, they have to be paid out as specified, and they have to be paid out before common stockholders are paid out. All right, this means that the dividends that preferred stockholders receive can be more or less than common stockholders. They're not always the same. Okay, they will also get capital gains, the same as we talked before, but generally speaking, not as much as common stockholders. Preferred stock tends to trade a little lower than common stock, and it also doesn't doesn't typically have the same growth rate. Okay, and their right to residual claim on assets comes ahead of common stockholders. So they are second to last in the right to a claim on residual assets. All right, next we're going to talk about bonds, and a bond is basically a corporate IOU. Okay, and the idea here is that corporations, when they need money, will issue a bond, and then investors will purchase the bond, which is essentially a loan to the corporation. A couple key aspects of bonds that you need to be aware of are, first, the maturity date. This is the date when the bond is going to come due, or in other words, the date that the corporation is going to pay you back. Okay. Next, we have the par value. This is the value of the bond that the issuer promises to pay the bondholder when the bond matures. So on the maturity date, the corporation is going to pay the bondholder whatever the par value for the bond is. Now, bonds don't always trade at par value. They're not even always issued at par value, although they commonly are. They can be issued, or they can be traded above or below the par value. If they are traded above the par value, that's called being traded at a premium. If they're traded below the par value, that's called being traded at a discount. Okay. Next term we want to know is the coupon rate. This is the interest paid on a bond expressed as a percentage of the par value. So if you purchase a bond that's got a par value of $1,000 and the coupon rate is 10%, every year you will receive an interest payment of $100 on that bond. Okay. Finally, we have current yield. This is the amount of interest earned expressed as a percentage of the bond's market price. So as we talked about, the market price actually fluctuates. Okay, so sometimes bonds trade above the par value, sometimes they trade below the par value. So as a bond is trading at a premium, the current yield would be a little bit lower than the coupon rate. If a bond is trading at a discount, the current yield would be higher than the coupon rate. And the reason that this takes place essentially is that what happens in the marketplace is sometimes we purchase a bond and the coupon rate is higher than the interest rate ends up being a few years later. Then people want to buy that bond that is paying out on a higher interest rate, so the value of that bond increases. Okay, and as we look at these things and we talk about the premium and the discount, essentially what we're getting at here is that the current yield is almost reflecting the correction of the marketplace. So the current yield across bonds should tend to be kind of similar, even when the coupon rate is different. And that's because, like we said, the bonds can trade at a premium or trade at a discount. Okay, a quick note on convertible securities here. Both preferred stocks and bonds can be offered by companies as convertible securities. And what this means is that the preferred stockholder or the bondholder can potentially have the option to trade their preferred stock or bond in for shares of common stock. And that will be specified in the initial sale of preferred stock and bonds. Not all preferred stocks and bonds are convertible securities. If they are convertible securities, that has to be specified. Next, we're going to talk about mutual funds. Mutual funds basically allow you to diversify your investment portfolio at a relatively low cost. So if I wanted to invest in 100 different companies and I logged onto my TD Ameritrade account to do this, I would have to pay, if I was to just go directly invest in 100 different companies, I would have to pay a transaction fee for each one of those investments, or 100 different transaction fees. If I was to invest in a mutual fund, I don't have to pay 100 different transaction fees to get in there. So I can diversify my portfolio, as the mutual fund is essentially a group of different stocks kind of bundled together. Okay, and there's professionals who manage these mutual funds for us. Now, obviously, they get paid fees, so that does take away a little bit from our earnings, but they're watching the funds and making moves that need to be made and keeping us informed when we need to make decisions. Okay, and then finally, it's pretty easy to withdraw your money from mutual funds. Next, we're going to talk about the primary securities market, and this is where stocks are initially traded. Okay, so first we talk about public offering and private placement. A private placement is when a corporation issues stock but only a few different investors have the opportunity to get in. So one example might be when we talked about investors such as Sequoia Capital. They can obtain stock through private placements that aren't available to the general public. Whereas a public offering is when a security is made available to everyone through what's known as an initial public offering or an IPO. So in the 2010s, we had quite a bit of buzz as several different social media companies like Facebook, Twitter, these types of companies went public with IPOs, and people could invest in them for the first time. The secondary securities market is probably what you're a little more familiar with. So there's a couple different components here. We have stock exchanges, which are physical venues for trading stocks and securities that meet their requirements. So if you think about the New York Stock Exchange, you would think about traders on the floor yelling, making hand gestures, and things of that nature as they trade stocks. Now, in order to get on a stock exchange, companies must meet a few different requirements, such as the size of the company, the number of shareholders that they have, the value of the company, and things of that nature. They also have to pay initial fees to get listed, and then annual fees to maintain their listing. Electronic communication networks, they allow securities to be traded automatically matching buyers and sellers based upon what they're looking to buy and sell. Okay, and this is a little bit faster and more efficient than a stock exchange. And then we have over-the-counter markets. Okay, and these are where we trade securities that aren't listed on exchanges. Okay, and the idea behind an over-the-counter market is that some companies aren't large enough to trade on an exchange, or perhaps they're not in a financial position to pay the fees, but their stock can still be traded through what we call an over-the-counter market. Now, as we look at personal investing, you want to remember that as a member of the general public, you can't directly trade your stocks and other securities. So as I talked about logging onto my TD Ameritrade account, even though I would log on there and determine what I wanted to buy and what I wanted to sell, TD Ameritrade would actually be making those trades for me. I wouldn't be making those trades myself. And there are two different types of brokers that we generally think of. The first, a full service broker. They provide a wide range of services. So not only do they help conduct those trades, but they'll advise on what trades should be made. They may watch my portfolio and manage it and call me if there are concerns. Whereas a discount broker basically provides the minimum of what I need. So I tell them what I want to buy, they buy it. I tell them what I want to sell, and they sell it, and so on. All right, a couple different types of orders that we'll talk about. A market order basically tells your broker to buy the stock at the best currently available price. So you're trying to get in no matter what. Whereas with a limit order, you're specifying the price that you're willing to pay for the stock. So if the stock is currently at $35 a share and you would be willing to buy it, if it dropped to 33, you could place a limit order that says to buy 100 shares at $33 a share if that becomes available. And then what happens if the stock drops to 33, as soon as it hits 33, your order will be placed and your stock will be purchased. But if it never gets down to 33, your stock will never be purchased. Now, a couple different strategies that you can use when investing in securities. You might invest for income. This means basically investing in preferred stocks where you know what the dividends should be, or bonds where you know what the interest rate should be based upon the coupon rate, and just investing for those steady income payments. You can look to get into market timing, and in market timing, basically what you're trying to do is you're trying to find the low point of where a stock is gonna trade. So, for example, during the COVID-19 crisis, we've seen airline stocks decline and move down and down and down. Okay, now if you were looking to find the low point of where airline stocks were going to hit and invest at that point so that you could wait for them to rebound and sell them, that would be an example of market timing. Investing for growth involves looking at companies that you think are going to become larger and more powerful, and investing in them early on. So, earlier I mentioned social media companies when they had their initial IPOs, and many people who were looking to invest for growth, believed that Facebook and Twitter were going to grow and wanted to get in early so that as the companies grew and their value grew, they could benefit from that. All right, value investing involves trying to find companies not necessarily that are going to grow, but just that aren't valued correctly based upon their current assets and resources. And the idea here is maybe you find a company that is trading at $20 per share, but based upon their current assets, you really think they should be trading at 25. Then you try to get in at 20 so that when the market corrects itself, you can sell at their market value. Challenge with value investing is a lot of different people are trying to do the same thing here, so it's very difficult to find that diamond in the rough that helps you be successful in value investing. And then finally, we have buying and holding stocks, and the idea here is that you're basically looking at stocks and saying, I expect the entire market to grow. So you're buying, a diverse portfolio, and you're not watching the market. You're just sitting and waiting and saying, okay, in 20 or 30 years, after the market's grown, my portfolio is going to have grown, and you move forward. So you have to be pretty patient to be successful with buying and holding. The stock indexes basically tell us how the market's performing by looking at a specified group of stocks that are in the index and looking at average prices and changes in those prices over time. And then last, we're going to talk about how you can check performance on a security. So first, we have the last trade, okay, and that's basically the value of the most recent trading value for a stock. And then the change is just what the stock's price was at closing compared to the stock's price at closing the previous day. Bid and ask looks at the highest price currently offered to buy compared to the lowest price currently offered to sell a stock. All right, your days range looks at the highest price and the lowest price during the day. Your 52-week range looks at the highest price and the lowest price during a year. All right, the volume is the total number of shares of stock that have been traded up to this specific point. So it basically captures, a combination of how many shares of stock are available and how active the stock is by looking at the total number of shares that have been traded. All right, your market cap's the total market value for all the shares, and we calculate this by looking at the total number of shares available and multiplying it by the current price per share. And then we have earnings per share, price to earnings ratio, dividends, and yield. And these are all kind of related here. As we look at these, our earnings per share are basically our net income divided by the total number of common stock shares. Okay, and then our PE ratio is found by dividing the stock's current price per share by its earnings per share. Okay, now our dividends look at the dividends that are paid out per share, and our yield is essentially found by dividing the dividend per share by the previous day's share price. So if we look at how much is paid out in dividends and divided by the stock price, that gives us our yield. And this has been our part 2 of our lesson on financial markets. Hope you enjoyed. Hope you learned something, and we'll talk to you soon.